The broadcast is now starting. All attendees are in listen-only mode.
Good evening, everyone, and welcome to this periodic edition that we've been doing now for about a little over a year, where we review some of the stocks that we've been doing over a previous calendar year. This would be the first of two times that we look at selections that we had done throughout the year 2022. So we have 8 of them that we'll look at. We'll come back in 6 months' time and we'll look at maybe another 8 from this. This isn't the same as sort of a portfolio review that you would do in your own personal portfolio or in a club portfolio. But what we wanted to do was just sort of go back and look at our stuff and see sort of how our judgments were and some of the things that we as better investors tend to look at when we're trying to evaluate something after we've already done work on it. So we had 48 stocks in 2022, and we're going to look at 8 of them, and let's go on to the next slide and we'll talk a little bit more about it. So here's our standard disclaimer. We're doing this presentation for educational purposes only. We believe, as Better Investing does, that you should conduct your own review and analysis of any company. And the stocks that we discuss here may be held by us. We'll try to tell you if we've done that. And also, if we're showing you any locations or sites or stocks that we're not endorsing or promoting their uses, products, or services. We are recording this and it will go up on our YouTube channel sometime, hopefully tonight. So let's go to our next slide. And again, I see a lot of regulars in there, so you're probably all Better Investing members. But since this goes up on the YouTube and you don't have to be a BI member, we'd like to give you something to sort of show you who we are and what we are. In these things, these are handouts, or those are hyperlinks there, the blue underlines, that if you have the handouts from tonight, they will take you directly to those locations to do it. If you can't seem to get it to work, then you can just go to betterinvesting.org, which is on the top of most of the pages that we have here. But we are a long-term fundamental investor, and all of us that are doing stuff tonight, we are all volunteers in the Mid-Atlantic region, either in Maryland, DC, or Virginia. So glad to have you with us. Next slide. And here's the YouTube page that we talked about that's put out by the 2 chapters. You can find it by going to YouTube, and it's at Digging Into BI, or you can just go into that where that green highlight is in the share part of YouTube, type in Digging Into BI, you'll find it. Do us a favor when you go there, subscribe, like each individual video that you see, and then go ahead and share that with people in your clubs or other people that are interested. We've just gotten over 100 subscribers. We'd like to maybe inch up to 125. I've seen a nice, good, steady growth in people that are looking at it to do it. All of our webinars are organized by what are called chapters in YouTube lingo, which means that there's sort of a break, so you don't have to listen to all of them. If you just want to focus in on one particular stock, you can do that. Let's go to our next slide. We're also up on Facebook, and so we had a promotion on this. Please make sure to do it. It's a great way to be able to connect with some of the, with non-BI members to be able to do that. And so here's an opportunity for you to do that and communicate and share with people that you want to be able to convince that the benefits of long-term fundamental investing. Next slide. And again, most of you I see are regulars, but if you do need to be able to get to us, there's our control panel. You can move that around. Your microphone is muted. We will take questions. Jonathan is sort of looking over things there to do it. You can type questions so that if you want to do that, you can send that out to us, and Jonathan will feed them to us as we go through these things. Let's go to our next slide. And also, here's a way to be able to get those handouts. It's that last one, audio problems. We really haven't had any audio problems in a while. Usually it's when people are on their computer and they don't have computer audio checked. There's only one handout tonight. And the reason is that if we did we're limited with GoToWebinar to 5 handouts, and we have 8 stocks that we're sort of revising. So we just gave you the slide deck for all of these. So that's the only one you'll have tonight. Next slide. And so here's what we're going to do. We did 48 stocks in 2022, obviously, 12 months, 4 stocks a month. We had 21 different presenters, and I see a lot of them are in the audience tonight. Thank you. 9 different clubs were participated, and we had 4 different individual members participate. So very broad setup of people from Maryland, DC, and Virginia. So thank you to all the people that helped out with us. You helped make this a success. So thank you. Next slide. So what we like to do is we like to sort of review our SSGs and see how they performed. And like I said, we're going to look at 8 of the more interesting ones. And we're going to ask the original presenters some questions like, is the sales and earnings growth story still there? Does your original investment thesis hold? Was there any news that sort of changed up on things like that? And then we'll also ask, after we look at 4 of them, we'll ask the audience to be able to vote on the one that they thought was the most interesting. And then we're trying to look to spend about 8 minutes on each of these sort of reviews or updates. So it gives you an idea of about an hour of going over all of this. And let's go to our next slide. And one of the things that goes on in Better Investing Community is there's an unofficial rule. You see I have it in quotation marks called the rule of 5, in that of every 5 stocks you look at, 1 will outperform your estimates, 3 will be about equal, and 1 will underperform. And that's standard in the SSG handbook. And there's a hyperlink if you don't have it and you want to get it from the BI store, you can do that. But if we go to our next slide, we'll sort of talk about where the origin of that rule of 5 came from. It comes from this book, Investing for a Successful Future, which is 65 years old. But this person, David Babson, was a growth investor. There's hyperlinks to his biography, but he was a growth investor right up there with Phil Fisher and T. Rowe Price, when a lot of people were on the value side, like Benjamin Graham. And so he was very active in our community in the 50s, 60s, and 70s. And he says, look, if you look at it with growth companies, carefully picked out growth companies, 20% will be disappointing, 40 will be average, 20% will be good, and 20% will be extraordinary. He also had another one for people that are looking at income stocks, which is maybe a little bit closer to the rule of 5 that we sort of espouse. But that's where it all comes from. Anyway, next slide. So what we're going to do is we'll look very briefly at 2 different ways that we can sort of analyze this. We have public dashboards up on Manifest. They're free to do it. We basically do it as a tracking portfolio. We start out each one with $100 in sort of fake money and say how have they performed since that particular point. And then we also will show you the overview. I've collected all the SSGs that people have done. I haven't updated them, but just so we can sort of see how is there a trend to certain stocks that we're looking at or certain sizes, but there's no performance metrics. So that's sort of the way I look at these 2 things. And let's go to the next slide and sort of review some of them. So at Manifest, I have 9 different dashboards up there, 1 for each of the years. I also have like all the stock to studies in one. I have all the undervalued features in one. And then the ones that aren't featured by them, I have in there. And then we're tracking the ones that the audiences have selected. So in 2022, we had 3 sort of somewhat ties. So we had 15 sort of winners out of the 48, and we'll look at how they perform as well. Next slide. So here are the links, and they should work. I know when I mentioned this 2 weeks ago in our regular July presentation, that someone reached out to me and was having trouble with it. And if not, we can make sure. I thought all the links are still working, but we'll take a shot at it and see if they are. But again, you don't have to be a Manifest member to take a look at these, and you can just sort of use them as a tracking portfolio. Next slide. So here's what we've done is that these are all the stocks from 2022 that we looked at, and these are the ones that are sort of overperformed. Again, we start everything out with $100, a fake $100, and everything is sorted by that value page. So you can see Oak Street Health is there. And as Jonathan pointed out, since he did the presentation on that, that has been acquired by CVS, so that number is going to stay stagnant. But the audience really liked it too, and it did really, really well. So any of the ones with a star next to them were ones in which the audience selected. Like I said, there were 15 in the 12 months of 2022. So there were three ones that were tied. And anything that's highlighted in yellow, those are the ones we're going to be looking at tonight. So we'll look at the first four. We'll ask for your vote on that, and then we'll look at the next four and look at those as well. So that gives you an idea what we're doing. Let's go to the next one, and we'll look at the ones we're underperforming. And really, there were only two that underperformed because, as you can see, Borg Warner there is just slightly above the $100 mark, whereas Nike and then Concentrix, which we're going to look at tonight, they did not do well. So, and again, those stars indicate the ones that the audience has selected. So you can take a look. I know that people have really liked PayPal and Generac, but yet it's sort of down there. So maybe there'll be something for us to look at when we come back and do this again in January of 2024. Next slide. So the next thing is let's look at the BI tools, and we just sort of want to see, are we looking at certain sectors, certain sizes more often than not? Again, 50% of these stocks are already predetermined for us because they come by way of the stock to study and undervalued feature, and they tend to skew towards a large size community. But still, overall, we can get a view of where we are. So let's go to the next slide, and we'll look at some of the images with that. So here it is. Again, I put this into a portfolio of all the presentations that are there. It's something I can't share with you, but I wanted to at least show it to you. Here's the consumer cyclicals, the area that we looked at the most. And you can see like consumer defensive and healthcare and communication services were really on the small side. And this is equally weighted because of the fact that once these went in, they stayed at that same price. So keep that in mind. So let's go to the next slide, and we'll see it by industry. And again, those colors still correspond with whatever the previous sectors were. But again, you can see there were a lot of auto companies that were featured, which are all in the discretionary. And that's sort of the reason why that sort of shows up a lot and the like. But yeah, pretty much, again, we didn't look at that many banks, which was really kind of surprising, or in the financial areas. So keep that in mind. Let's go to our next slide. And so here it is by the companies. I noticed some of these numbers are off, and I was trying to figure out why, because they should all be the same amount, but you can see a couple of them have shown up twice, and that makes no sense. So there's some kind of glitch going on, and when I double checked on it, it was off. So they really should all be equally weighted, and I think it should be all 1.7% because the price hasn't changed, and if they all go in at $100, that's what they should be at. Anyway, so regardless of getting into the minutia of that, it just sort of at least tells you that, kind of an interesting cross-section of them. Let's go to our next slide. And so here we are by this is the one that, again, I was sort of leading into, is that most of these are either large or mediums, and we only had two companies that were in the small size, Universal Display, OLED, and Metropolitan Bank. So yeah, we're not pulling out as many of the smaller ones as we'd like. But again, it's just sort of like what people are picking, that's sort of like what they like. But other than that, is, be nice to have fewer larges, but some of them, again, are determined really by what the Security and Review Committee selects for us. Next slide. So here are the 8 stocks again that we're going to look at. We're going to do 4 of them, and then we'll take a break, ask for your vote, and then we'll do 4 more. So we're going to look first at Delta, Rio Tinto, Agnico, Eagle Mines, and America's Car-Mart, and then we'll ask for your votes, and you can see where they sort of came from. Let's go to our next slide. And this is sort of a good reminder. I really am a big fan of this book, which is about 30 years old, is that the key would be to stay with them as long as the fundamental story hasn't changed. So, the participants here will tell you that as they go through it. And let's go to our next slide, and I think we're probably ready to start. Yep. Cheryl, why don't you get us going?
There we go. All right. Again, my name is Cheryl Patterson. I belong to the DC chapter and also to McNova Model Club. Delta Airlines, on the New York Stock Exchange, their ticker is DAL. They were the undervalued feature in July of 2022. And they were also BI's top 100. They were number 72 on the list in April of 2022. I put down that picture below to show that all the things really that Delta Airlines stands for, and also where they are and the investment scene. They are part of the culture right now. They're part of that travel culture. People seeing new things, experiencing new things. And they're also part of a global network. Airplanes very much are on a global network, as we saw in September 9th, 9/11 rather. And, you know, when they were all taken out of the sky. So they really are on that global network. And they also have a balance sheet that is contained within Moody's and S&P Global and the Fitch ratings as far as being a top balance sheet. And they are also up 62% since this presentation was last done back in July of last year. So let's take a look at Delta Airlines. The price at the time of selection was $29.53. The 52 current week high price at the time, again, of selection was $46.27, and that's the selection for this review. And the low price at that time was $28.10. And the closing price when I did the review for this on July 20th was $48.55. So they'd even gone up from that 52-week high. They broke that barrier. The annualized return, as I said, since the presentation was 62%, and that includes dividends. Now, the original forecasted 5-year earnings per share growth estimate was 2.3%, and that was based on getting resources from independent means, Value Line, Morningstar, Yahoo, those type of places. And the averaging amount, I usually try to get 3 or more, and it came out to about 2.3%. Same thing with the sales growth rate. That was at 69.2% on the trailing 12 months. And the current trailing 12 months of the earnings per share growth rate is a whopping 368.2%. So it really has gone up quite a bit. Again, in the upside downside ratio zone, it was a buy at 3.5 to 1. The total return for the high, using the high price to earnings, is 13.7%. Projected return on using the average price to earnings is 1.4%. And the buy price that is going to satisfy an upside downside of 3 to 1 and a 15% total return is 27.9. And the buy below price based on zoning selection was $30.50, with the closing price on July 6th being $29.53. So here's my picture of Delta Airlines. Here's their cockpit crew and people working the plane as they're either going or coming, can't tell which, in America's airports. So here is kind of a description of Delta Airlines. Their last fiscal year end was December of 2022, so they closed at the end of the fiscal year. The industry is airlines, obviously. The sector is industrials, and they are a large company size with over 10 billion in sales. They're one of the world's largest airlines, with 300 destinations in more than 50 countries. They operate what's called a hub and spoke network. So they have hubs in Atlanta, Georgia, New York, Salt Lake City, Detroit, Seattle, and Minneapolis. If you are taking a plane using Delta, you are more than likely to touch down either at the end of your trip or somewhere in between in one of those hubs. And then they have spoke networks from there, which means that wherever your final destination is from one of those hubs, if you do have one that goes out, it's going to land in going out from that hub to their next spoke network. They gather and distribute passengers across the globe, and they have a very close-knit partnership with American Express, so that if people who usually will get travel credit cards, they will try to get it that sort of syncs in with the airline that they use the most. And so they are saying that this is a growth opportunity, having this partnership with American Express credit cards. And less than 1/3 of their Sky Miles members, which is their promotion with their cards and with their airlines, members have a co-brand credit card. And the profile of the co-brand credit holders is usually about 6 trips a year. And then average, they spend about 4 to 5 times more than non-members. So as you can see from that graph for 2017 to 2024, there's quite an increase there. Obviously not in 2020, which is why it was left off of that graph. But you can see, and 21, they broke even, but starting in 22, you can see the growth there.
4 minutes, Cheryl.
Okay, thank you. Now we have a visual analysis. Here is the, to the left is the original analysis that I did. You can see the drop in 20, but you can see they're starting to lift back up and get back on course there. Of course, COVID is still going on. People are still talking about it, but there's a difference in 2022. People want COVID to end. They want the restrictions to end. And they also want to get out of their house. They want to get back to some kind of normalcy. And you can see that in the next graph to the right from 23, you can see an increase there. And you can also see a greater increase of both the sales and the earnings there, as well as the price bar, that little red notch. They were back in 22, they were at the bottom of the price bar, and now they're at the top. So there is a great deal of change, as you can see also by the sales and earnings per share from a year ago quarter, 12.7% sales and earnings 147%. Here is the growth trend graph for sales and for earnings, and as well as pre-tax profit and pre-tax profit divided by sales. And you can see there is some increase in the earnings. It's the line came down, but it's going back up again. Same thing with that pre-tax profits, and these profits divided by sales were on an even keel. So the conclusion, my original conclusion, it's a large growth company that has been impacted by COVID and the global economic stability. It's a well-managed recovering company. The current PE indicated that it might be overvalued. Dow stopped paying dividends in 2021, but it had plans at that time to reinstate. It was a buy up to $30.50 with the current price at $29.53 and an upside downside of 3.5 to 1. And I said that it could be a candidate to include on a watch list to study when both the pandemic and economic situations started showing improvement. Now, on my revised conclusion, I said the company was still coming back from the impact of especially the global economic instability, but it was still a well-managed recovering company. It's the current PE indicated that is still overvalued, and they have not yet reinstated their dividends. but we've got a buy now up to $52.70, with the current price being $48.55. Upside downside has increased to 4.1 to 1. And again, I said it could be a candidate to include on a watch list to study when the economic situations start showing improvement and more people can afford to fly. Inflation is something it has come up more than it was a year ago, as we well know, and still it's keeping some people from flying. And also businesses, which is a large part of the travel industry, are doing a lot more with on Zoom or some other conference call. And so that is also impacting the number of people that are flying for that situation. And that is my review.
Thank you, Cheryl. And next up, Ken, why don't you tell us all about Rio Tinto?
Okay. Next slide. Okay, so the price at the time of selection was $57.93 when it was presented on around September 9th of 2022. 52-week high was at $84.69. 52-week low was $53.21. It recently closed at $66.48. Annualized return since presentation is at roughly 24%. The 5-year sales growth rate is at 4.5%, and the original forecasted 5-year EPS growth rate is 6.5%. So based on my judgments at that time, I had it as a buy with a 7.2 to 1 upside downside ratio and a total return based on the high PE of 27.7%. Next slide. So Rio Tinto, it's in the industrials and metals and mining area, and in the materials sector. It is a large size company. It is a diversified miner. Iron ore is their dominant commodity. They also have lesser contributions from copper, aluminum, diamonds, gold, and industrial minerals. Next slide. So when I originally presented my judgments for sales and earnings were 4.5 and 6.5% respectively. High PE was 8.6, low PE was 4.3, and my low price is $44.70, and it was sporting a dividend yield of 6.3%. And then as of the 21st of this month, I kept the same sales judgment. Did make a change in the earnings judgment. Did not make any changes in the high and low PE or the low price. And currently we have a dividend at 5.1%. Next slide. So my conclusion at the time that I originally presented it is that Rio is a large size commodity company with impressive cash flow growth. It's well managed. It was undervalued as it was trading under its 5-year average PE. It was a buy up to $71.70, and I believe it was a stock worthy of consideration. Next slide. So currently, Rio is experiencing lower pricing on the company's core commodities: iron ore, aluminum, copper, and titanium oxide. They may experience better demand from its end markets, housing, manufacturing, and construction, as global inflation is alleviated and interest rates ease. It's still trading under its 5-year average PE, continues to be a well-managed company, and I currently have it as a hold at $66.48. Next slide.
Good evening. I'm Brian Koenig, Maryland Chapter Director, and this is the first cut update for Agnico Eagle Mines Limited. Next slide. these are the sections of Agnico Mines after they combined with Gold Lake, I think it was. Next slide. That was Kirkland Lake, sorry. The takeaways from before, from CFRA, was that gold was losing its meaningful market to the cryptocurrencies, even though skeptical people decided to use cryptos instead of gold. There's clear higher demand for crypto to help it. Following the Kirkland Lake Gold merger, they had more assets. In 2022, the record was 3.135 million ounces. The gold expected in the next couple years goes from on up to about 3.4 to 3.6 in 2025. Next slide. So Agnico Mines, the price at the time of the original selection in October 22 was 42.23. The 52-week high and low were 67.14 and 36.69. The current closing price on 7/21/23 was 52.09. The annualized return was just about 33%, even though it was a short period of time between the two presentations was only 0.8 years. The 5-year sales growth was 15.3. Earnings per share growth was 21. In the original forecast 5-year EPS growth was 15%. As we can see in the summary boxes there, the original one from October 1st had it as a 9.6 upside to 1 in the numbers there. You can see that in the latest one, it's gone down to a 1.0 to 1 upside downside ratio and in the hold range. And that's about all I need to see on that one. Okay, next slide. And here are the original and updated SSGs. And across the top is the information from a PERT chart to show the top line is the one for the latest SSG. And you can see that there are no red marks in that. That's good, with the total return over on the right of 6.2%. There's been a big recovery, and that means that there's probably something that has to do with I'm struggling for the word. It's sitting there. Expenses. The pre-tax profit jumped up. I couldn't find anything on that, but we'll see. So those are the updated ones. Next slide. So kind of in conclusion, it's still a medium-sized growth company. It's still well managed. The original baseline was on sale with those prices there, the 9.6 to 1 upside. The basic materials purchase if it improves your portfolio. The current one with the closing price of 52.09 with a 1.0 to 1 upside, 6.2% return. Still not too bad, but I'd say that it's turned into a purchase candidate if it improves your portfolio. Next slide. To look at the 3-year price chart, I think this is important. If you look back there in October 1, 2022, it was at 40.23. Since then, it's come up to the $52 in 7/21. It looks like the low was going to be about $40 when we last looked at it, which is why it's kind of impressive for growth. But it looks like it's going to be in a little trading range from maybe about 45 to 60 for a while until the economy figures out what it's going to do, inflation and wars in Europe and that, at which time it may start to have a steady increase. And next slide. Thank you.
Thank you, Brian. So I'm up next, and this is going to be America's Car-Mart. This was the undervalued feature in February of last year. And since that original presentation, it's gone up 14.5% annually. So that's actually a really good mark for them to hit. Let's go to our next slide. So again, here's sort of my original selection. You see over in the lower right, that was my original judgments that were there. You can see what the 52-week high and lows were. It closed this weekend at 112.05. So that means it went up, what's that, like $20 or so, almost $20. And the consensus long-term estimate for them when I initially did this was 11.2%. And you can see that the original sales and earnings growth were 11 and 10% respectively. So those look like pretty decent numbers. Let's go to our next slide. So here's from the original presentation, just to remind people of where it's coming from. They're in what's called the non-prime auto finance market. In other words, they're getting people that have trouble getting credit other places, so they're probably going to be paying a much higher rate for it. And they're also going to default at a higher rate too. But that this is an area that they seem to do pretty well, and they have been for a long time. They've been around since 1990, I think. And let's go to our next slide. And so in the used car market, this also comes from their slide deck from the company. And you can see where they are down there at the bottom, and some of the other ones that are quite popular, CarMax, Carvana, AutoNation. But what they really are is, unlike some of the others, is that they really work on those people that are can't really get credit elsewhere. And that's sort of where their niche is. Next slide. And here's the thing I wanted to show is that, so this is a quarterly data tab that you can get. And what I'm focusing on with those yellow arrows is that's where the number was when I did the presentation. So in the upper left, that's the sales in green. And you can see that solid green line. That was the original judgment that was in there. And you can see, look, it has 6 straight quarters that are down. Really 5 from that peak, 5 down quarters from there, and still above the average, but still it's just like that's not necessarily an encouraging sign. If we look at the one in the upper right, that's the earnings, and again, there's our earnings. That solid blue line is the earnings projection that we had, and again, look at it's going down below where the original judgments were, which is not a good sign. And if you look down in the lower left, that's the pre-tax profit margin. That too is going down. And then the profit margin in black as a percentage of sales in the lower right is going down. Everything about this is screaming, this is not doing well. And so let's go to our next slide. And here was my original stuff that was going on. And I was it's still a small, medium company. It can be on sale. I thought it as a buy, could be a candidate for purchase. But I was like, I had it as a buy, but I didn't feel like it was totally a great one. Let's go to the next slide here, and I'll give you what my conclusion is here. Is that really I didn't put it up here, but if you were to pull out Car-Mart right now and look at the visual analysis on it, those numbers look awful. And here's the thing is I was trying to figure out what was going on, and it's not covered by a lot of people, so it's kind of tough. The thing is that if you look at their investor relations presentation, it looks awful. I mean, it's almost like two different realities. Their investor presentation is talking about all the great things that they're doing and their performance. Yes, they're buying back shares and stuff like that. They don't pay a dividend, but it's just like, there was no real discussion on what was going on. Now, I didn't listen to their investor presentation. They may have had a little bit more there. But to me, when I look at those numbers, and then if you want to cross over and do some valuation, you're really crossing that barbed wire fence that we talk about. So these valuation figures, you could sit there and get this thing to look like it's a solid buy, but the fundamentals aren't there in my thing. I don't think they're really my results would not be tethered to reality. So I got this as a upside downside ratio of 2 to 1, where we like to get to 3 to 1, but I take that with a grain of salt. I mean, I just am not comfortable with what they're doing, and this is clearly a case to get on out. Now, in their defense, a lot of the insiders are buying this company, are buying this. So if you're one of the management, they're buying more, so they think that this is going pretty well. But again, if you look at some of the things there, I just don't see it. and it's sort of a head scratcher. We made money with it. Good time to get on out and leave it for another day. But I just don't see where this is going to go. Next slide. So now that we've done that, Cheryl, if you can be able to release the first of the two polls, and we can have people vote on it. And I don't know if we want to take any questions here, Jonathan, or do we want to save them for the end? What do you think?
There is one question from Robert regarding Rio Tinto, and that is, what is the basis for the EPS growth rate being so much higher the second time around?
Ken, you want to answer that?
It's simply my judgment based on the future, the cows that are driving the growth. Again, their potential, the cows that are driving that growth is, the growth in electric vehicles, as well as the use of their products in manufacturing and it looks like in the housing area.
Well, I'm looking at the voting.
Oh, I'm sorry, go ahead.
I was going to say, I'm just looking at, we only have about 50% of you people voting. It doesn't cost you anything to take a vote. Just listening to what we have. You can spitball, doesn't matter. You can pick something that no one else has. I see we're getting now up, we're starting to inch up towards 60. I'd like to see it get a little bit higher. But Jonathan, do you have another question?
Yeah, we have one more for you regarding Car-Mart. If Car-Mart is doing so poorly, why keep it as a hold?
Well, again, the reason for doing that is like I said, is I'm crossing the barbed wire fence. If you look at the numbers there, as I said in there, I would keep those numbers with a grain of salt. So again, I just do it because that's sort of the completion of the SSG. But again, I've sort of indicated that I'm not comfortable with the fundamentals, so it really doesn't matter. I see we're at 63, 65%. One more. And anyone else going to vote? Last chance. Can we get one more vote? Maybe get up a little bit higher? All right. Might as well close it out, Cheryl. And share with everyone what we got. And so even, Delta Airlines is a big winner. I think the rest of us, we sort of felt like, so-so with ours. But anyway, good job. And let's go on to the next slide and we'll continue. So now what we're going to do is we're going to look at the ones that we'd call the underperformers, but actually two of the underperformers still did better than the average. And the first one up will be Brian Koenig, and he'll tell us about MasterCard.
Thank you, Kevin. And I will try and do better than 4% with this one. This is MasterCard, symbol MA from New York Stock Exchange, and it was the DI stock to study. Since the presentations in between, which was a little over a year, it's got 11.2 compound annual growth rate. So that's a good start. Next slide. A quick review that MasterCard has the 4 revenue segments, and they're listed there. You can review those. I'm not going to go over each one of those. Next slide. The key takeaways that MasterCard generates revenue by charging fees for dollar volume that goes through there, and the customer accrues the charges, not MasterCard directly, and they're paid to the issuing financial institution. Next slide. And there's nothing like a good picture to explain this. Down on the lower left is a card holder that buys an article for pays $100 for it from the merchant over on number 4 on the bottom right. The merchant sends the charge up to his bank for $98, for $100, but he's only going to get 98 because the 2 banks that own the money will take some money out of it. This shows a 2% fee. I think most of them are, the cards are 4%, so make that $4 instead of $2. But that just shows that the MasterCard is just the conduit to get the money back and forth. Other than to have its symbol on a card, it really doesn't do much more than just charge a couple cents for each transaction. Next slide. So the price at the time of selection back in March of 2022 was $344. The 52-week high was $401.50. The low was $306. The current closing price on July 21st was $397.49. The annualized growth rate over the 1.4 years that we held it was 20.9%. The 5-year sales growth was 10.5, earnings per share growth 19.6. In the original forecast, 5-year earnings per share was 16.8. As shown there in the results summary box, when we first did it in March of 2022, it was 4-to-1 upside downside. It's down to 3-to-1 upside downside. It's still just in the buy range by doing that. So there's still a possibility of making money being in the buy range when you buy it. Next slide. On this one, the two SSGs again with the PERT on the top. In this case, the top row is the original March of 2022. The bottom row is the July 21st. You'll notice that to the left, the 4 boxes that are red. If you go over to the right and 2 boxes to the left from the yellow marker, the estimated earnings per share growth. So there are 4. And if you go back over to those 4 boxes, what you have there is you have March of 2022 to March of 2023 listed there, since that's what it takes it. And of course, March of 2022, you had, that was before COVID really hit. So that's why those values are in the red for that. But in the recent one, you can see that the 15% estimated growth, all of the growth values, the changes are above the 15%. Therefore, there's no red, with the total return of 13.2 according to the PERT chart. And when you look at the from the baseline to the current SSG, you see that they appear to be still aimed reasonably up straight, and maybe the earnings per share will grow a little bit faster than anticipated. Next slide. So conclusion, the MasterCard is still a large growth company. It's still well managed, on sale a little bit, as we can see there. It's trading below its 5-year average PE. It's $336 is a buy, up to $368, 4.9 to 1. No, you know what? I don't think I updated that. I apologize for that. The market being lower would be a purchase candidate, but we've seen from the graph that it looks like it's still a good buy. Next slide. Okay, here are the actual numbers. You see back in March of 2022, the 344 was right there at the end of the arrow. Through about the October of 2022, where it hit its the low at a little bit below 285, probably around $280. Since then, it's continued to climb all the way back up as people started to run out of the stimulus money, and they're starting to use more transactions using the credit card. And as you can see, from about March of this year, other than a little dip that toward the end of May, it's been higher highs and higher lows. So I think that it'll probably continue to go up to the latest price of $397.49. Next slide. That's it. Thank you.
And I'm looking at your SSG that you sent over to me, Brian. Your upside downside ratio when revised was 3-to-1 with a total return of 10.2.
Thank you.
Those people that are playing at home. Okay, Ken, why don't you tell us about Borg Warner?
Okay, Borg Warner was the January undervalued feature, and I presented it back in 2022. Next slide. So the price at the time of selection was $45.10. Set a 52-week high of $55.55 and a low, a 52-week low of $37.76. It recently closed at $66.48. The annualized return since presentation has been 11.54%. So based on my original judgments, I had it as a buy with 3.7 to 1 upside downside ratio and a total return based on the high PE of 15.9%. Next slide.
Ken, just a moment. If we go back to that slide, that calculator, we were talking about this. Somehow I didn't get it saved correctly. It's not 11.5%. It was actually 5.9 over that same time period. So error on our part. But other than that, it's good. Back to you.
Okay, next slide. All right, so Borg Warner is in the auto parts industry and in the consumer discretionary sector. It is a large company. It's a tier 1 auto parts supplier with 4 operating segments. The air management group makes turbochargers, e-boosters, e-turbos, timing systems, emission systems, thermal systems, gasoline ignition technology, powertrain sensors, cabin heaters, battery heaters, and battery charging. The propulsion and drivetrain group produces e-motors, power electronics, control modules, software, automatic transmission components, and torque management products. The 2 remaining segments are eponymous fuel systems and aftermarket groups. Next slide. So based on my original judgments, I had sales and earnings at 8.5 and 9.3% respectively, high PEs at 17.9, low PE at 10.3, with a low price of $33. Based on recent changes and judgments, I did raise the earnings. I didn't make any changes to the sales and earnings. I did adjust the high and low PE to 10.6 and 4.3, and the low price is now at $44.70. Next slide. My original conclusion, I had it as a large size company, well managed, trading at its 5-year average PE as a worthy candidate to study, and certainly as a buy up to $47.10 with a 14.7% return. Next slide. So currently the company looks for net new business due to increased penetration of company products and higher electric vehicle revenues. It may benefit from a tailwind from foreign currency thanks to the strength of the euro against the US dollar. Continues to be a well-managed company. It is in a buy range. It's a buy below $53.30 with a 5.3 to 1 upside downside ratio. Next slide.
Thank you, Ken. And so I'm going to come back with my second one, which is Nike. And this was a stock to study back in April. So what's that, a year and a quarter ago? And it's been down 13.5% since the original. Let's go to our next slide. So again, here's what it was at the beginning. When we initially did it, was 133.52 in April of last year. You can see sort of the ranges. Again, if you have these slide deck, you see these hyperlinks where we have the analyzed rate of return. You can click on that and you can actually save that as a location. So you can, if you want to look at some annualized returns, you can put in any ticker symbol and any duration and you can take a look at it. So my consensus on this long term was 8.8% for the earnings growth. I did 9.5 for sales back then, and I also did 12, almost 13 for the earnings growth going forward. Let's go to our next slide. So here's some things from the original presentation that I sort of wanted to take a look at the CFRA industry report is pretty good. Again, Nike dominates this one. They have the strongest credit rating, but some of the other companies that are a little bit smaller tended to have better ratios on the debt to EBITDA. And again, if you want to understand more about either one of them with this slide deck, go ahead and click on that and we'll take you to the information on there. But I sort of, the ones that are highlighted in yellow in the lower right-hand side were some of the ones that sort of struck me as being probably better comparisons for them, even though they're not all in the same setup. Let's go to our next slide. So again, from the original presentation, and I found this from this guy's YouTube channel, Jaman Bawanda. I'm sorry, I know I didn't even come close to saying that right. I apologize. But the Nike, what they're trying to do is what's called a triple-double plan, is they want to do twice as much innovation, twice as much speed to market, and twice as much direct connections. And what they're trying to do, if you look at these other slides here, normally they would sit there and manufacture, send out to distributor, and go to retailers, and then to the general public. And they're trying to do more that's directly to them. And you can take a look at this presentation, or the triple-double plan from Nike is in the lower left, so you can understand it a little bit better. Very interesting in terms of what they're trying to do. Next slide. And so again, I did this with the previous one, is that here's the quarterly data. You can see with the yellow, there's where it was when I initially did the presentation. Upper left is again the sales. And you can see that solid green line is my sales judgments from back then. And you can be able to see it really sort of dropped and then evened out. But it's hitting right about where I thought it would. And then if you look at the earnings, same thing, it dropped down. It may be coming back up a little bit from there, but it's still below where my estimates were. That would be a good reason for me to sort of trim my estimates going forward. If you look in the lower left-hand side, the pink, again, that's a pre-tax profit margin. That has dropped quite a bit. I think that's sort of the reflection of some of the things coming out of COVID, that they did really well in one quarter and were slowing down. But the more natural trend is somewhere right about where it's been for the last 3 or 4 quarters. Pretty consistent, not great, not awful, but I think it also shows you that this is kind of a narrow margin business on a lot of things. Next slide. So here was my original conclusion on this, and I had it as a buy up to 124, and it could be a candidate for purchase. And they are really transforming the way that they're doing, selling their products. And again, this is not an undiscovered gem. This is one of the largest companies in the world. It's in the Dow 30. So take it for what it's like. Let's go to our next slide. And here's sort of my revised conclusion. I have it as large size, slow grower. It's really about what I expected in terms of growth. Like I said, I trimmed the earnings there. Management figures are okay. They're not great, they're not bad, but I think it really just shows they're in a mature growth and that they're really in a highly competitive environment. And I think that this one, again, if you look at some of the metrics, if you use a projected relative value or the relative value, it's probably fully priced. It doesn't mean it's something to run away from. But that PEG ratio, which is a measurement of the PE ratio to the earnings growth, normally you'd like to get it somewhere around 1.5, and this is double that. Again, slower growth with a higher PE is not necessarily a good combination to get something on sale. Upside downside ratio, I have it at about 2.5 to 1, where we'd want to get to 3 to 1. And I have it a buy up to 93. I still have it really as a hold, because I just don't, I think it's okay. I think if you actually own this and you've had it for a while, the amount of dividends that are increasing on that, it could be a nice dividend play. So if you have it in that kind of setup, the overall yield on it is, I think, like 1.5 or something around that range. So it's about average for a dividend payer, not spectacular. But again, the rate at which they're increasing it would really be pretty good for those people. Next slide. And last but certainly not least, Cheryl, give us your second one.
Yeah, I think I'm the least of the least. So so that there goes my story. Concentrix, they're on the NASDAQ. They were the stock to study in February of 2022 when I originally presented. They were also in a first cut stop report and on the heat map in the Technology Center. So looking at the time of selection, the price was $190.90. That was back in the end of January. The 52-week high price, the time of selection was $191.45. 52-week low price was $105.42, and the closing price in July of this year was $84. So the annualized return since the presentation, including dividends, was negative $40, 40.15%. Excuse me. The original forecasted 5-year earnings per share growth estimate was 15%. The current trailing 12-month sales growth rate is 13.2%. And the trailing 12-month earnings per share growth rate is 7.5%. The judgments from the original was petted in the buy zone at 7.4 to 1 with a 19.5% total return, projected return of 15.2%. The buy price to satisfy the upside downside, 3 to 1 and 15% total return was $231. The buy below price based on the zoning selection was $231.5, and the closing price was $190.92. So CX ecosystems, they had expanded at the time. This is from my original presentation, and they were creating new ways for customers and brands to connect. And the CX stands for customer experience. So they were doing it through chat and mobile and social networks, websites, in-person, 800 numbers, letters. And the market at the time was about $90 billion. So there was room for growth. So in the last fiscal year end, which was November of 2022, they are an information technology service, and in the technology sector, the company size is medium, which is 1 billion to 10 billion in sales. And they specialize in customer engagement and customer management. They provide end-to-end solutions that facilitate communication, and this is between clients and their customers. They provide analytics and process optimization. They support client-centric operations. They have back offices processing across the enterprise, and they provide insurance, marketing, and automation solutions in these 4 distinct areas. So they are trying to create a diversified global CX leader, and the market opportunity out there currently is $550 billion and counting. And this was back in end of March of 23. So this is Concentrix in a nutshell, as we say. So here is the quarterly graph, the growth trend graph. There is sales, and as you can see, after 22 February, they're on a downward slide there in terms of sales. And we know what happens then. Sales grows earnings, and there go the earnings, and there goes the pre-tax profit. And then that's all going to affect the price. And the percent of pre-tax profit over sales, they're still toward those last 2 quarters is a definite downward trend. So my original conclusion was that CNXC is a medium-sized, steady growth company. They're a fairly well-managed company. They were at that time overpriced, trading at above the future average high 5-year PE. They were a buy up to $231, given the 3 to 1 upside downside and the 15% total return. and they could be a candidate for a watch list. Now, some of the things I have looked at since that conclusion, or found anyway, that one of the good things was that we're an online technology, so they weren't affected by things like COVID shutdown. But there's been a lot of discussion and confusion and maybe even scaring of people in privacy issues. People are wary of their private PI information and how it's shared. And I think that has definitely affected this type of industry. Also, there has been a steady growth over time of competitors in this industry, and all trying to get their part of the market share. Also, companies may be doubtful of how this is going to increase, the service is going to increase their customer base or their bottom line. And so that's going to, affect how companies are going to become part of the business, become part of their customer base. Now, my revised conclusions are it's still a medium size, but it's still a steady growth company. It's still fairly well managed, but with a slight debt increase. Right now, they're underpriced. They're trading it below their future average high 5-year PE. It's a buy up to $217.20. And it could be a candidate for a watch list if that earnings per share and pre-tax profit rise. And that is my look at Concentrix.
Okay. Well, now it's time to, we did have these, actually we have 2 underperformers and 2 overperformers, but let's go ahead and release a poll. Notice a couple other errors we had in there. So this was kind of sloppy today. Sorry about that, folks. But this is what you get. Next time we'll have to just double our pace, so we'll get even better. We'll work on that a little bit better. We're all volunteers in case anyone's listening. So let's see how we're doing on the poll. And do we have any questions that we can take care of at this point, Jonathan, or do we want to wait until we're done with the poll?
Well, there is one question from Robert regarding MasterCard. What were the causes of the new low price in October 2022? And did Visa also experience the same feature on the price chart? That's for Brian.
I'm not sure about Visa. I'd have to go back and look at that. I'm trying to get the, 1 second, I'll get to the, okay, I had that slide available at slide 58. What was the question again, Jonathan?
What was the cause of the new low price in October 2022? And did Visa experience the same feature on the price chart? I think that really had to do with the economy. We were in a bear market then. I think that was actually around the trough of the bear market at that time.
Yeah, 2022. That was initially everybody was getting a lot of money, and so they were, if they charged something, they could pay it off right away. But then later on, I think that the money wasn't there, and so people were kind of using up the rest of that before they started using their cards, and so that was probably a case of why the income went down a little bit, the revenue. But I want to have to give you a guess on that. I'll see if I can find something about Visa here before we're done.
I was looking at it. Visa looked like it got pretty well beaten up in October as well. So I think Jonathan may be onto something.
Yeah. The whole economy was hurting at that point.
Cheryl, let's close out the poll. I think we've stopped having people vote and share with everyone what we got. And even with those questions, they still want to be able to have you, Jonathan, look, or Brian. They wanted MasterCard.
I think that was a mercy vote from the 4% before.
Yeah, it could be.
I'll take it.
All right. All right. Anyway, so there's where we are. Let's go. Are there any other questions, Jonathan, or is that pretty much it? I know we had one on
Yeah, Al
someone
has a
having trouble with the
question.
links, and I know that person, so we can talk afterwards on getting those
Yeah,
links from Manifest working.
there's one additional question from Al. This is also regarding MasterCard. Were there any other concerns about MasterCard's increase in long-term debt?
I don't think so. The MasterCard will probably only incur debt if they're going to acquire another company. They may put debt in order to buy it. But since MasterCard is just a conduit for the money going through, they just go with the from the bank of the person, the company that had the product that sold it to the individual through their bank. So they really don't have much overhead. It's they're kind of just sit there and money goes one way and money goes another, and as it goes by, they snag off 2 to 4% and just make it available for whenever I go to to charge something around the world. I just give them a card, I get the product, and everybody's happy.
Anything else, Jonathan? People can also raise their hand if you want to, and we can unmute you if you want to ask any other questions.
No additional questions.
Okay. Let's move on. Let's see what else we got here. So again, any questions or comments, either to the Maryland chapter, the DC chapter, or if you want to reach out specifically to the O's of us here at Digging Into BI, there's our Digging Into BI Gmail account, and there's a picture of some of us from last year's BINC from the 2 chapters. We didn't have an in-person one this year, so we don't have a revised photo. So you're just gonna have to see us like this for another year. Let's go to our next slide. Again, I know a lot of you are coming through our listserv, and our Carol does a great job of getting everything out for that. But please, you don't have to be a member of the DC chapter. Sign up here. You'll see the link right up on top there, betterinvesting.org/chapters/DC-regional. Don't have to be a member of BI to get on to there. We'll certainly include you and find out different events that are coming up. Let's go to our next slide. Jonathan, you want to tell us all about the good reasons why someone would want to be a volunteer?
Yes, Better Investing is made up of hundreds, if not thousands, of people that give up their time and in order to educate others. So Better Investing is really involved in educating individuals. We are a community, and I always like to say it takes a village. And so it really requires as many people as possible to help educate one another so that we can all grow together and achieve our financial goals. So if you are interested in volunteering, and we all highly recommend it, then check out the website, Better Investing website, the chapters, the individual chapters is more information on volunteering. Thank you.
And you just finished up 2 weeks with Charles where you guys were teaching youth in Howard County. Is that correct?
Yeah, that's correct. Yeah, Howard Community College has the kids on campus, and Charles Bright is another one of our directors for the Maryland chapter. He and I assisted the kids on campus with better investing principles and techniques, and we had 30 kids over the last 2 weeks that we educated with respect to investing, and they did absolutely fantastic. You know, we all had a great time, and it was a lot of fun.
Good. I'm looking forward to hearing more about it from you, Jonathan. I know you've put a lot of effort into that, so thank you. All right, let's go to our next slide. And here's what's coming up in 2 weeks' time. Our regular August one is coming up. The stock to study is booking. The undervalued feature is Skyworks. We were talking about Visa. There it is. It's going to be Jonathan. I think you're doing Visa, are you not? And
Yes, that's correct.
and
Yes.
Parent Network Lee's going to do. So those are the four that we'll be looking at on Monday, um, August 7th at 7:30 Eastern. Come and take a look at those. You can also start to prep on those things if you want to. And please join us. Let's go to our next slide. Here again, I forgot to put all this yellow means I had to change it and I didn't. But Brian, your chapter had had your planning meeting this last weekend, and you've set up when you want to teach. You're going to do an in-person teaching of the SSG class. Is that correct?
Yes, and I'm looking for the date. It will be,
And it's going to be in Southern Maryland, or at the College of Southern Maryland. Is that correct?
yeah, it'll be at the Plata campus on Saturday, October 21st. Just go to College of Southern Maryland and sign up for it. It'll be under the personal, personal enrichment in the financial part of it.
Okay, very good. Well, sorry I didn't get that stuff in there correctly, but yeah, if you want to do it in person, some people like that. Maybe a little bit of drive if you're not in the Southern Maryland area, but worth it because I know Brian and Roger do a really good job on that. Let's go to our next slide. And Cheryl, why don't you tell about what we're doing here in the DC chapter? We have our date set and the new feature we're working on. Are you muted?
Sorry about that. Anyway, we are doing this virtual as we have for the last several sessions on the 2 consecutive Saturdays. The last Saturday in October, which is the 28th, and the first Saturday in November. We're going to be teaching from 9:30 in the morning till 3:30 in the afternoon. We've had excellent reviews from people that have attended the classes, and the cost is $30 for BI members and non-members alike. And you also get a free retake within a year of that initial class. We're going to have a new feature where we're going to do a post-class mentorship for up to 2 to 4 months post-class with small groups of about 2 to 5 students. And we will have each 2 veteran SSG users as mentors for monthly, about an hour in length, in a very supportive environment. I had done some with this last group of class, and it went very well. People were there with their questions and had done some SSGs and seemed to come out of it with a better understanding of where they've had questions or problems. And hopefully the next time we get together, they will have shown improvement and gone farther in their understanding of the SSG tools.
Yeah, and we also, excuse me, we had several directors, which is a fancy title for a volunteer at the DC chapter, that are willing to be mentors like that. So we've got a really nice list of folks there willing to help out. Some people may not necessarily be great presenters, but their knowledge on how to use a form and how to be able to communicate it are excellent. And so they were willing to step up, and it gets back to what Jonathan was saying in terms of volunteering. One of the reasons I started volunteering was because I wanted to learn more. So even if you don't feel yourself as an expert, please come and volunteer for either the Maryland chapter or the DC regional chapter, if you're outside your local chapter, whatever you're in. And when you're around other people like that, you're going to end up getting better. So, and the whole idea is to become a better investor. Let's go to our next slide. And so if you're looking for members for your club, this is another thing that we want to do, is that there are links in both the DC chapter and the Maryland chapter on how to visit a club. That way your club is featured on their chapter page. Both chapters only have like 3 or 4 clubs up there. But you get a chance to be featured. And then another thing is that if you want to be able to also, everyone's always usually looking for more members, do one of these stock presentations and be at a future event. And just like we would be mentoring people that are just starting out with the SSG, we would certainly be helping to mentor you on how to do your presentation or how to be able to learn some of the things with your SSG. It's the second way to be able to sort of promote your club because you'll be able to tell when it's there. So again, if you're in a club and you want it, doesn't matter what level you're at, we'll definitely work with you and make sure that you're competent enough to be able to go forward. We do know some people have trouble doing speaking and stuff like that, but if you can do an SSG presentation, we can certainly work on all the other things that go with it. And if you're struggling on some things, we're here to help. That's the whole point of being in this organization. So please come on down. Bob Barker's looking for you, or I guess it's what Drew Carey now. Drew Carey's here with you, and we want to be able to help you become a better investor. Next slide. And there's where you can be able to find this up on YouTube. Hopefully I'll get it up later on tonight and share it with other people. Make sure to like, share, and subscribe to Digging into the BI on YouTube. And we'll see you next month when we do, or I should say next month, in 2 weeks' time when we do the August Digging into the BI. Last look at questions. Do we have any more questions, Jonathan, or are we pretty much done with them?
Yeah. There's one comment from Reddy regarding, he says, if you publish your presentation prior to meeting, we can review and prepare some questions during the presentation.
Oh, you want volunteers to do even more stuff in advance, huh? We were struggling just to get this stuff ready in time, and you can see some of the errors we had. But again, we're more than willing to take on additional help. So that if you want to be able to help us prepare with that, we'd love to have you join us because we can do as much as we can with that. So if you want to help out, whatever level you're at, just sort of send another question in the affirmative, and we'll come. Don't worry, I'll find you.
Well, I think part of his question really had to do with having the presentations before the actual go live. But I think it's really important. We do send a list of the companies that we will be covering. So it's probably more beneficial to do your own research and then come with a prepared SSG. And that might be more helpful while we're reviewing our presentation. You can sort of follow along with your own analysis and see how there's a comparison that way. So that's sort of I'm hoping that really answers Reddy's question.
Okay, and yeah, Reddy, do you live in Maryland, DC, or Virginia? Or are you outside this area? It doesn't matter. I mean, it's not like we're going to kick you out or anything. So, but yeah,
I've seen Reddy give some presentations.
Okay. All right, so you're in Connecticut, but moving to Florida. All right, well, I think everyone wants to move to Florida. But yeah, no, we'd like to do that, but we just don't have everything, as volunteers, and some of us working and some of us trying to take care of grandkids. It sort of fills up the schedule quite a bit. But yeah, but I don't think
There's one more question.
Go ahead.
I'm sorry. I'm sorry. Alice says, I will have questions on booking. Very interested in this company. It doesn't pay a dividend. Can the booking presenter explore the decline in sales that occurred in 2020? I'll also do some research as well. Good.
Well, yeah, and that's what we do. I mean, keep in mind what Booking does, Al, is that I can tell you that right away, is that because I actually own Booking, is that global pandemic sort of cut out on travel. People were not traveling there. So why would, they can't generate any sales if they're not, if people aren't traveling. So that's the real thing with that. That's to do it. But yeah, I mean, that's when we do the regular monthly ones, we try to get those a full month in advance so you can see them to be able to take a look at it. But yeah, anyway, that is it.
I also have something to say on that. I think that booking is kind of in the same situation that the airlines are in, whereas companies that were a huge part of bookings for travel have sort of seen what's happened during the pandemic when they've had to do meetings that were normally travel to meetings, do them online. And I think that has changed companies' minds on where to put those travel dollars. And I think that's also changed the industry quite a bit as well.
Reddy, since you're asked another question, I've actually unmuted you so you can be able to just speak. You have some good questions, and let's just hear from you. So if you want to go ahead and speak away, go for it. Are you there? I can't hear you if you are speaking. You did indicate you saw about 120 stocks on the slide. On the main page here, there were 48 of them because, again, we do 4 new stock presentations per month, 12 months. 4 times 12 is 48. So we do 48 presentations. We're not going to review them all because, again, that takes too long. And it also would require, we're not necessarily managing a portfolio or the like. What we are doing is just sort of reviewing some of them that are kind of interesting. It's a lot different than if you were in a club or you own them personally, but we're just trying to be able to show people how to be able to do these. That would be completely unwieldy to be able to look at 48 stocks on a quarterly basis. And then also doing that over multiple years. So anyway, but that's really it. Any other questions? Or have we hit the end here?
I think we hit the end.
Okay. Well, thank you very much for being here, everyone. Appreciate having you. Thanks to all our presenters for helping us out and the like. And we'll see you in 2 weeks' time when we look at those 4 additional stocks. And we'll be continuing this through the rest of the year. And in the middle of January, we'll come back and look at 4 more stocks from the 2022 year and see what things we can sort of learn from them. Take care. Good night, all.
Good night. And for people who had a problem downloading the handouts, just send an email to the Digging into the BI email that we showed previously, and that we should be able to help you out there.
Absolutely. Good night, all.
Good night.
Good night.